Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, myself, Market Chameleon are registered investment advisors or broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. We'll be talking about screening call spreads for best returns in flat to upward markets. How are you doing this morning, D?
Good morning, Will. How are you?
Good. Let me share your screen.
Good morning, everyone. And we're going to come back to our call spread screener that we've been talking about the last couple of days and look at a different type of screen. And first, let's navigate to it and we'll discuss it. So I'm going to come up on the main menu under screeners. We're going to look at bulk call spreads. I'm going to click on that. And then we come to a page where we have our filters up top, the data elements below that shows the different combinations of call spreads. And what we're going to do is look today for call spreads that, based on particular factors or parameters, where you can design a call spread that it benefits from either a flat or an upward moving stock price, okay, at expiration. So if you're looking for, let's say, a stock that you believe between now and a certain expiration you designate has a better chance of either staying right where it is or moving higher, there's a way to use a call spread to capitalize on that type of outlook. So let me see if I could find one. So right here, I'm going to slide down here, and well, actually, let me just read you from left to right the data elements, and then I'll show you what we mean. So if we right now in our data table, we see we have symbols on the left-hand side, and then stock price, market cap. These are all sorted by market cap. These over here show us the market price of the spread if you're buying the call spread, with some historical benchmarks we discussed yesterday. Here we define the spread. So you can see here November 21st expiration, buying the 225 calls on the 230 call. So when you're doing a call spread, it's buying one call and then selling another call at a higher strike in the bull call spread in the same expiration. You could have different combinations of strikes, as you can see here: 225, 230 strike, 220, 225 strike, 215, 220 strike in the same expiration in NVIDIA. So all these different combinations are, you have different prices, risk profiles, and so forth. And we use a screener. It's helpful to start analyzing them against each other. Okay. With the call spread, you have, the risk is the price you're paying in a debit call spread, right? So it could be, you could buy a call spread, it could go down to zero if it's completely out of the money, or in the best case scenario, the stock's above the both strikes, the higher strike where it's completely in the money. So here you could see that, in NVIDIA, the November 21st, 225, 230 call spread, right now, the ask price where people are willing to display where they're want to sell it is 18 cents. But if the stock on November 21st is above 230, this spread is worth $5. So your max gain is $4.82. You paid 18 cents for something that could be worth $5. So you potentially can gain $4.82, right? And here's the stop price, 182.25. So you could see it's right now it's below both strikes by a significant amount. So I'm going to slide down here just to show you where there are scenarios where the stock, so here you have, a stock price of 182.25, and you have strike prices of 175, 180, right? So you're buying the 175 strike, selling the 180, and right now it costs $3.05. Well, if the stock's above 180 at expiration, this spread will be worth $5, right? The difference between the strikes. So if it's worth $5 and you paid $3.05, that means you would gain $1.95, right? Something that's worth $5, they paid $3.05, it's a gain of $1.95. And if you're gaining $1.95, if you're making $1.95 profit on something that you risk $3.05, well, that's a 63.9% return, right? On the money you have at risk. You risked $3.05, you made $1.95. Well, you made 63% on the money you had, or the amount you had at risk. But if we look at this scenario, what does that stock have to do? Like, what does the stock have to do for you to, get that yield of 63.9? Well, it has to stay above 180, right, at expiration. So if it's already at 182.25, if the stock is flat, if it's at 182.25, well, that's great for you. Both of these are in the money, and you're fine. If the stock goes up from here, you're fine too, right? It has to be above 180. So essentially, it could even go down a little bit, right? From 182.25, you could go down to 181. You're still fine. So the idea here is, well, if we're looking for NVIDIA right now and we're thinking, okay, well, I think that this, at November 21st, I selected an expiration, and we could select it up, top here, but we'll keep it at November 21st. The idea here is, if I think that my outlook is, that the stock will be flat essentially. What's the best yield I can find, in that scenario, right? If that's my outlook. So you could see there's different combinations there. Here's a 63.9. Here's an NVIDIA, the 177.5, 180 call spread. Well, that yields a little bit higher, 66.7, right? So that's if our assumption is 182.25 or higher, well, this one offers a better yield than this one. This is a better yield than this, right? So there could be different combinations here. And what we want to do is say, well, show me the one with the highest yield. I want to start with that. Show me the one with the highest yield, and not just for NVIDIA, but all the stocks out there, right? That's my starting point. Is I want to see which ones offer high yields for stock flat or higher. Okay. So of course, there's so many combinations here. By even doing it by hand or tabbing through, if you're going to start tabbing through 1,600, different pages, it would be very long, and tedious process. So to make that quicker, we could come up here and we have a filter for that. You see here, show best. So if I click on this, it gives us different options. And one of them is show me the best return if the stock is flat, by symbol. The stock is flat at expiration, and show me all this, each one for some best one in NVIDIA, Google, whatever. So let's look what that brings us. So I'm going to click that. Now it's going to do that filter for us. and bring us back, okay, 3,000 entries. So let's see what we have here. So see an NVIDIA, Apple. So in NVIDIA, what it found was the November 21st. Remember, we're right now, we have them all set to November 21st. It was the 177.5, 180 call spread, which, right now the offer is 150. Well, if it's above 180 at expiration, this will be worth $2.50. So that's a gain of $1, right? You paid $1.50. If it's worth $2, that's $1, $1 higher. So that will be your return, which is 66.7%. So in Apple, it listed two. So there are two different combinations that essentially give you a similar return. 56.3 was the 225, 255, 257.5 call spread, and the 252.5, 257.5 call spread. So it's two, but this one probably in that case looks a little bit better just because it has a little bit bigger cushion to the downside. Here's one in Microsoft. So the one it found was the 515, 520 call spread. It costs $285. The stock is flat, right? It's already above 520. The stock is flat, it's worth $5. That's $2.15 gain. That will be a 68.3% return. So this here allows us to quickly kind of, list this. Some of them don't have anything. Here's an IVV. But this quickly goes through, does these scans for us, and we could actually sort by this. Let me see if I could sort by return it flat. So this is the lows to highs, so let's do it this way. So then we could look, we could sort by any of these columns, and we could see, where sometimes you have a potential, here's a 25-cent call spread that could be worth 50 cents. So that would be 100% return, right? You risk 25 cents to make 25 cents. And this allows us to quickly filter out and narrow down those types of combinations to do further research, right? Now we could kind of narrow down the strikes, the prices, and the potentials, and then go and look, further into it. So, Will, I'm going to stop right there.
Hey, great job, D. Actually, Cincy was saying he used the screener this week and saw a Netflix spread, and someone had bought 4,000. He bought a one lot and made $900. So the guy who traded 4,000 is, by his calculation, made almost $4 million. Pretty interesting stuff.
Oh, wow.
Great job, D, as always. Thanks for bringing that to the Chameleon community. This is the last webinar of the week, so we'll see everyone on Monday, hopefully. Great job, D.
Thanks, everyone, for joining. Stay safe out there and have a great trading day.
Have a great day, D. Thanks for bringing this to us. Bye-bye.
Bye.
Hey, everyone. Thanks for joining another live webinar. Watch out for the weekend webinar series that will be out tomorrow at 6 a.m. with your cup of coffee. Remember to follow us, like us on all the social platforms, particularly you, Swami, because since you're in late, you have to give an extra thumbs up and an extra follow. Let me share my screen really quick for one other thing. For anyone who's new, you can go anywhere on Market Chameleon and hit start the free trial. You get a 7-day free trial with Market Chameleon, and it's a great way to see all the tools and features. Once again, thanks everyone for joining. We will see you on Monday. Have a great day, everyone. Bye-bye.